kind of one of the remarkable things of this year is that almost everything got hit. So bonds, one of the worst years ever. Stocks, pretty bad year. Um, Gold, was like flat. At one point it was up, then it was down. Now it's kind of flat for the year. Um,
Bitcoin.
and obviously Bitcoin had a bad year. Growth stocks had a horrible year. A lot of those look like shit coins, basically. Like these unprofitable, super high valuation companies just got killed. And so there's been a couple ways to, if you were like a fully long energy or something like that, you made a lot of money. But outside of being very specific, it was a pretty hard year to make money on. So it's more about damage control.
Wasn't 2022 a very troubling year for the world economies? Not only the economies of the countries, but 2022 disturbed and even wiped out households and common citizens as well. So seeing this trend, what would happen in 2023, the year everyone has high hopes for? Well, LYN ALDEN, a macroeconomist and founder of LYN ALDEN Investment Strategy, has got some insights to share. She has been saying that this decade is of inflation and many downs. So it's a great idea to listen to her and find out what she thinks about 2023. If you were someone who wants to make a good investment in 2023 and know which assets would be profitable, you should watch this video. In this video, we will uncover what LYN ALDEN thinks about inflation, recession, interest rates, and the year ahead for the economy. Let's get started. If you want to know what will happen in 2023, you should know what happened in 2022. Honestly, 2022 was one of the worst years markets could imagine in their histories. It was the year when people had to worry about lowering the losses and having assets that lost value slower than other assets. So that's exactly what happens during catastrophic declines and market crises, where people rush towards saving their money and assets. LYN ALDEN said that in 2022, only cash did perform better than other assets. But wait for a second, wasn't the cash that lost value as well? Well, yes, the cash lost value, but the loss was lower than what other assets like bonds, gold, stocks, and cryptocurrencies did. People who had money in their bank accounts knew their money was losing value due to inflation. The Fed was printing more money, making the already present banknotes of lower value. Hence, some people decided to buy bonds and treasuries because even if they lose value, they pay you some dividends. Hence, if we adjust the value they are losing with the returns they are bringing, bonds and treasuries become the best investment option. However, don't forget that we are talking about 2022, when everything was in decline. Perhaps in 2023, these options would also save people. But does it mean LYN ALDEN suggests these options? Well, you have to wait for a few minutes to know that. There was a stock that performed impressively unlike all other stocks in the market, as LYN ALDEN said. Well, that's the energy stocks because the changing political landscape has made energy the most precious of all commodities. Hence, anyone who invested in energy in 2022 made a lot of profits when everyone else was losing money. And yes, LYN ALDEN said that companies that even paid some dividends were the best people could have in 2022. The reason is at least those companies were paying something in return at the time when other stocks were losing prices. LYN ALDEN said that it appears the same market conditions will reach 2023 as well. In other words, bonds, treasuries, the energy sector, and cheap companies that pay dividends might be the best investment option in 2023. Listen to what LYN ALDEN said about that.
This year was ironically cash. So inflationary environment, it's ironic to buy cash. If you look in the U.S. System, if you hold dollars in a bank account, you're getting paid near zero most likely. But if you're holding short duration treasuries or money markets, you're at least getting several percentage points to offset some of that inflation. So cash is kind of like a safe haven to lose value slowly. Um, Another thing that's actually gone up this year is a number of decent dividend paying value stocks, right? That went into the year pretty cheap and that, have generally continued doing pretty good cash flows and paying pretty high dividends. A lot of those have actually been some of the best places you could be, right? So you did better than cash, you did better than gold, you did better than most risk assets that went down. And so those have been some of the best places to be. And of course, there's some specific sectors like energy stocks and things like that that at varying points of the year did very well. But a general rule was cheap, profitable companies that pay dividends has generally been the best bet this year. We also have, housing is coming down for obvious reasons, but it's still up year over year. And so, especially in linear markets, if someone bought like a reasonably priced house early this year with a low fixed rate mortgage before mortgage rates shot up, they're generally still doing pretty good with that trade or that investment, however they want to view it. So there have been a number of ways to either gain a little bit of value or at least lose value less quickly than other places. But kind of one of the remarkable things of this year is that almost everything got hit. So bonds, one of the worst years ever. Stocks, pretty bad year. Um, Gold, was like flat. At one point it was up, then it was down. Now it's kind of flat for the year. Um,
Bitcoin.
and obviously Bitcoin had a bad year. Growth stocks had a horrible year. A lot of those look like shit coins, basically. Like these unprofitable, super high valuation companies just got killed. And so there's been a couple ways to, if you were like a fully long energy or something like that, you made a lot of money. But outside of being very specific, it was a pretty hard year to make money on. So it's more about damage control.
But does it mean 2023 will be as disastrous as 2022? Here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Well, we don't want to scare you, but things appear to worsen in 2023. LYN ALDEN said that this decade would be the inflationary decade, where prices of goods will continue to increase with every passing year. In other words, if 2021 saw 10% inflation, this percentage would increase in 2022, which it did. However, there is good news for 2023 only. Prices of goods and services will go down. Since the demands are slowing down and central banks are trying hard to control inflation, LYN ALDEN said that in 2023, we would see the money appreciating. That's good news for common citizens. However, this doesn't mean every commodity's price will come down. The countries and households which are directly dependent on energy will still see high goods prices. This will be especially the case with European countries where the energy crisis is worsening every day. LYN ALDEN talked about the energy supply the US is offering, which she thinks will increase. She said that for now, and in 2023, the energy supply will stay low, and the Middle East will follow the same strategy. They will ensure that the market is not drained with oil, bringing the oil prices down. Since Europe is the continent paying higher prices, why shouldn't the oil producer keep the supply low and sell energy at higher prices? Perhaps this won't seem good, however, that's the reality. Therefore, the energy sector becomes profitable for an investor in 2023.
So I view us as in a disinflationary cycle within what will probably be an inflationary decade. And that's something that I've been estimating for a while. If anything, it actually came a quarter later than I thought. So if you look at my writings before, I thought that the peak in inflation would come in probably like quarter two of this year. And it kind of dragged on to like quarter three, I think in large part because of Russia. And so they just kind of added fuel to a fire that was already there and extended it a little bit. But essentially, you have, a lot of that stimulus money is wearing off. A lot of that demand destruction, or at least demand slowdown, takes place. And so now we're in kind of this period where central banks are fighting back, fiscal authorities are trying to fight back, trying to gain control of that inflation. It's working better in some markets than others. And so my overall expectation is that we're in a disinflationary environment. But when we look out at, say, 2024, 2025, I think that's where we risk having another inflationary spike because the energy situation is still not fundamentally resolved. Basically, by releasing U.S. oil, by China being shut down partially for a while, there's been ways to kind of keep oil from skyrocketing. But if you want to have another cycle of growth ahead, let's say, after we get through 2023, if you go into 2024, you want another cycle of growth. Well, we haven't seen a lot of new energy supply come online. And so that's kind of ready to be a problem all over again.
Are you saying anything with regards to investment in new energy supplies?
So around the margins, there's some. You always, basically like, U.S. shale oil. There's actually a recent survey that they do them quarterly throughout Texas, for example, to see what the plans are of energy capex. And there's really nothing remarkable, right? I mean, basically, everyone's saying, okay, inflation's transitory. We're not going to chase this. We're not going to, radically increase our energy production. And then, you have policies like windfall taxes in parts of the world and things like that, where they say, well, I mean, if we don't even have good clarity on what percentage of our profits we get to keep from this, maybe we should just hold off for now and not invest. And so I think, partially private sector decisions, and then partially, public policy implications contribute to pretty low, new investment. So it's certainly looks like it's going to be higher than this year, but not way higher. And that's compounded by the fact that a big percentage of that amount that's going to be higher is inflation. So the actual, when you factor out and say, okay, how many actual barrels are we going to get online, to offset our declining existing wells? I think the answer is not much. I mean, we've already seen kind of a flat line in U.S. shale rebounding. So we still have not hit our high water mark in terms of U.S. Oil output, kind of the pre-COVID level. I think there's a good chance we will eventually get to that level. But the initial several months of say 2021 and things like that, we were rapidly going back up in terms of oil production, and now we're kind of like rolling over and flatlining because the marginal barrel is always that much harder. And for example, analyst Luke Groban would describe it as peak cheap oil, which is that there are plenty of oil and gas sources still out there throughout the world, but that we already have a lot of the low-hanging fruit, and so we're turning towards things like shale that, for example, rapidly depletes. You have to keep heavily investing in it in order to just maintain the output, let alone grow the output. And then you have other unconventional oil sources that on average can be somewhat more expensive. And then you have some of the cheapest sources of oil, like a lot of the Middle Eastern oil, for example, that's not really growing anymore. And so I think that's kind of the tricky environment, that you need quite a lot of capex in order to get an amount of oil that is.
Now here's the hard question. Will there be a recession in 2023? Well, according to LYN ALDEN, 2023 will be a year of recession, and for good reasons. She said that the picture doesn't look great for 2023 because now, we have started to see the recession signals. She said that the U.S. yield curve is inverted now, meaning that the 10-year treasuries are giving lower yields than the 3-month treasuries. When does this happen? Why are the treasury holders of 3-month treasuries paid more yields than those who hold 10-year treasuries? The reason is simple. The Fed doesn't know what the future will be. LYN ALDEN said this is a sign because the yield curve inverted itself in the last 8 recessions. So whenever the yield curve is inverted, it's a clear sign that a recession is in the making and will hit soon. LYN ALDEN said that this has never happened, that the yield curve inverted itself, but we didn't see a recession. Every time we saw a recession whenever the curve was inverted. Hence, that's not a false signal. Another reason for the recession in 2023 will be the maturing debts. Usually, every country has fixed interest rates, which means they offer loans at fixed rates. Whether interest rates increase or decrease, the borrowers will have to pay the interest rate they had picked when they took the loan. However, a time comes when companies, households, and people's loans start to mature. In other words, they are paid off, and the new ones have to take loans. But when they do so, they see the interest rates are many times higher. They have to take loans, and their payments eat up a major part of their income. This calls for a recession because people don't have money to spend. What adds fuel to the fire is the layoffs which companies are doing. More people are unemployed these days, which makes a recession inevitable. Listen to what LYN ALDEN said about that.
How resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. It depends on a few different variables. So right now, for example, the U.S. yield curve is inverted, which means that the 10-year treasury is a lower yield than the 3-month treasury. The last 8 recessions, the yield curve inverted before the recession, and there's been no false signals, right? So it's never inverted, and then there's no recession. Now, the caveat though is that sometimes it's like a recession happens 2 months later, and sometimes it happens like 2 years later. So there's a pretty wide gap for how long it can take for a recession to materialize. Number one, and another challenge is that monetary policy happens on a lag, because especially in the United States, but in a number of other countries, a lot of the debt is fixed rate. And so, just because mortgage rates, for example, shot up dramatically, does not mean that the average American homeowner is paying a higher mortgage rate. It basically means that fewer mortgages get taken out at those higher rates. Fewer people ever want to leave or sell their current home. They want to lock in and keep their current mortgage rate. And so basically a lot of those are unaffected by the increase in rates. And so what happens is quarter after quarter, potentially year after year, as rates are at a higher level, some percentage of debt matures and gets rolled over. Like some corporate debt matures and gets refinanced at these higher rates. Some people just have to move. Things happen, and then so low interest rate debt gets refinanced at higher rates, and that eats into incomes. It eats into things that they otherwise could spend money on. More of it goes to bondholders, banks, things like that, and away from the non-financial industry, and that can contribute to recessionary conditions. Especially because if you look at office like commercial properties, they've never recovered yet from the combination of COVID and remote work, right? So it's not that remote work was always going to happen to some degree, and what COVID did was say, okay, we're going to take the next 5 years of remote work and push it into 3 months. That kind of trend was rapidly accelerated, and so even as it bounces back somewhat, a lot of companies have already decided that they need less office space than they used to, and so there's higher vacancy rates, for example, in New York office real estate. I'm sure many other cities as well, including cities throughout Europe, cities in other countries. And so over time, as those holders of those properties have to refinance their debt at higher rates, that just puts pressure on them. And so I think that it's one of those things where we're kind of in a more like a stagnant environment right now, and we'll see if it descends into an outright recession. So right now, U.S. unemployment, for example, looks like it's bottoming and maybe turning up a little bit. You see consumer confidence, CEO confidence, measures like that are very low. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure, and so that's been a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. And combined with the China's reopening, that's kind of the one variable to keep watching to say, okay, the U.S. is kind of in some ways purposely putting itself into a recession to try to regain control of inflation. But then the question is, as the market, looks at their inverted yield curve and maybe stops, paying more for the dollar, it allows these other indebted entities around the world to potentially stabilize and start doing okay. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth.
What do you think about 2023? Would the markets come back and show positive growths, or will we be seeing the same declines, recessions, and inflations worsening every day? Comment right below in the comment section. Where are you thinking of investing and why? Do you want to watch more videos like this one? If yes, please like and share the video, and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.